All right, good morning, everyone, and welcome to the Finance Auditing Committee of February 22nd, 2024. And can we have a roll call, please?
Thank you. Good morning again, everyone. We're going to start with committee members, and that's Director Dorsey, who's absent, Giudice.
Here.
Rosebolt.
Here.
Hernandez. Here. Maston.
Here.
Rodoni.
Here.
Vice Chair Parr. Here. Chair Rabbit.
Here.
And President Cochran.
Here.
Thank you. You're still a committee of the whole. Also still in the room is Directors Garbarino, Hill, Snyder, and Terrio. Thank you very much.
Great, thank you very much. Moving on into agenda item number 3, which is ratification of previous actions by the Auditor Controller. That's on pages 5 through 26. The PFM report starts on page 9, and Monique Spike is here from PFM to give us a brief presentation. Monique, welcome.
Good morning. So I'm going to focus on the month of January's employment report because I think that was the most exciting news to come out of the economy in the month of January. So that is page 12 of your packet. A couple of things to highlight here. One, the jobs market continues to surprise investors at large. January added 353,000 jobs, which was way above expectations. And what's really interesting about that is that the December numbers were also revised upward. And so what that means is over the last 3 months, we had about 900,000 jobs added to the economy. Further notable about that was the job gains in January were broad-based. So every major industry, with the exception of oil, gas, and extraction, saw job gains. Most notable was the professional and business services industry. We also saw retail and social assistance. And so those are, categories that, we like to see jobs added to. Now, what's the concern with that? The concern is that the economy continues to be moved along by the consumer. And when you have positive job reports that we've seen in January, it enhances consumer confidence, which contributes to the consumer spending more. Now, GDP, the primary indicator for economic growth, has seen some blockbuster quarterly numbers. Third quarter GDP came in at 4.9%. Fourth quarter GDP came in at 3.3%. So what are the implications of that? If the consumer continues to be happy, confident, and spending at this accelerated rate, that puts pressure on inflation. That puts pressure on pricing. And the Fed, as you know, is really looking to bring that inflation metric down through their policy. So after January, what have we seen? We've actually seen some of that come into play. The inflation numbers were a bit higher than anticipated, and that's put some concern on investors and has caused the markets to realign themselves with what the Fed was communicating to us at the end of last year. Mainly that they do intend to cut rates, but they're continuing to be data dependent. So what we've seen is month to month, January interest rates haven't moved. But since the end of the month, we've seen the 2-year Treasury jump significantly. It went from, if you turn the page in your report to page 14, the 2-year Treasury ended the month of January at a 421. Currently, it sits at about a 470, and that's just reflective of the market's expectation that perhaps the Fed is not going to move as quickly to cutting rates as previously thought. So now what are we expecting? We're expecting rate cuts later this year. Perhaps in June. And furthermore, perhaps 3 rate cuts rather than the market estimate of 6, which was a couple weeks ago. So how does that impact the district's portfolio? Well, for our part, on page 16, we have continued our practice of being cautious. We have expected rates to basically be in a range, but with the expectation that rates will come down eventually, we have continued to purchase investments out longer on the curve. So you see here, we purchased some U.S. Treasury notes with maturities in 2028. And we have essentially bucketed those with other sectors, such as federal home loan mortgages, some auto loan trusts, and some asset-backed securities. We believe this strategy will allow the district to continue to take advantage of higher interest rates, but be appropriately hedged in the event that rates don't act as expected, which has been the case. Other things to note if you look at the summary of assets on page 18, we are continuing to diversify the portfolio by sector and issuer. There has been a lot of chatter in the markets about credit risk and credit rates. We have continued to be cautious about all of that and ensuring that you're not overly exposed to any individual issuers in the portfolio. We believe that the credit in the portfolio is of very high quality. We continue to watch earnings reports and investment reports. As a general trend, corporate issuers are focusing on expense control, but we still see earnings and balance sheets fairly strong where we would like them to be. The maturity distribution of your portfolio is shown on the bottom left corner of this page 18. And again, our goal is to make sure that you have enough liquidity for any needs that come out of this portfolio, but are also being able to take advantage of where we find opportunity across the yield curve. And the portfolio's yields are fairly high given the average life of this portfolio. So we feel as though the district is fairly well positioned. That's going to conclude my formal remarks. Are there any questions for me?
Anyone? No, I think we're good. I don't see any hands raised, but appreciate very much you being here and giving the report today. Oh, I do. Director Hill.
Just a quick comment. I noticed that there's less on automobile companies tending that way, and I think that's really a good thing. So thank you.
Director Maston.
Yeah, just a comment on page 18, the pie chart, it looks like the dotted lines from the boxes don't actually, go to the right spot on the pie chart. Am I wrong on that?
I'll take a look at that.
Like commercial paper says 5%.
There.
Commercial
Yeah,
paper says 5%, and it points to U.S. Treasury, but that's the only line that goes to it. I'm just curious.
We'll take a look at where those leader lines are coming from and correct that.
Okay, thank you.
Anyone else? I think we, again, thank you. Is there anything else that you did? Thank you, Monique. Thank you for being here. With that, this is an action item, and I'll look to, there's no more committee discussion. I'll look and see if there's any public comment on this particular item.
We have no public comment in the room or on the line for item number 3.
So if I can get a motion to accept the ratification. We have a motion and a second, and I'll ask for a voice vote. All those in favor, please say aye.
Aye.
Anyone opposed? Hearing no opposition, that does pass unanimously with all present. Thank you very much, and thank you again, Monique, for being here. Moving on to 4A, which is the item that we just heard in B&O. This is authorize the budget increase in the fiscal year 23-24 Bridge Division capital budget for project 1923, which is the Golden Gate Suspension of Bridge seismic project. I'll just look to my colleagues. Any questions on this one financially?
Move to approve. Second.
We have a motion and a second. Before we take the vote, I'll just ask real briefly if there's anyone from the public who'd like to speak on this item.
We have no speakers in the room or online for this item.
Okay, with that, again, we can take a voice vote. All those in favor, please say aye.
Aye.
Anyone opposed? Again, for the record, that passes unanimously with all present. So thank you very much. There are no actions today on item number 5. Moves us to item number 6, which is the approve the renewal of the marine insurance program. Kelly Vitale is here to give us a brief presentation. That's on pages 33 to 36.
Good morning, Director. So today before you, I have the annual renewal of our marine insurance program. And as you're familiar, the program consists of 5 lines of coverage. I'll just go through each one briefly, just in case you might have any questions. So, thanks. So the first line of coverage that we will be renewing is our protection and indemnity insurance. And that covers just about all of the maritime liability risks that we might have with the operation of the vessel. That particular line of insurance will be renewable for, sorry, I got my notes mixed up here. We'll be renewing that particular line with also a credit of $62,000 for layup during COVID. We still have another $62,000 coming back to the district. So we'll see a 2.5% increase because of their relationship with the Steamship Mutual Protection and Indemnity Club that I've spoken to you about before. And so protection and indemnity will go up about 2.5% for a whole of $502,731. The next line of coverage that we will be renewing is our hull and machinery. That covers again against the vessel and or physical damage that we have to the fleets. We're seeing about a 2% increase in that particular area. Our renewal price for that coverage will be about $284,621. And then our marine general liability. So we have a marine general liability and then an excess, and those are separate and distinct from the protection and indemnity. So just to be clear, those are separate lines. They cover different things. The marine general liability, that's the coverage for any bodily injury or property damage during the loading and unloading, usually of passengers in our particular instance. That one saw an increase because the expectation based on our coming out of COVID is that we're going to continue to see a small increase in ridership. And so they estimated that we would go from 100,000 to almost, $1 million to 1,300 in the renewal period, which began February 20th. So that quote went up to 30,500 from the prior renewal term of 25,500. The next line of coverage is the excess marine liability program. And this picks up where the general liability stops.
Sorry.
Okay. And so this particular coverage we are required to have because of a contractual relationship we have with the San Francisco port. And so we will continue to provide the $50 million in coverage, and this premium will renew at $118,375. And then the last line of coverage that we have for the marine program is the pollution. And obviously this protects against the vessel pollution claims, and it works in conjunction with the coverage that we have with the Steamboat Club. And so this premium renews at $6,920. Overall, the total package of coverage for our marine insurance is $943,167. It's just roughly a 3.1% increase for the year. And so at this time, I'd take any questions if you have any.
Great, thank you very much, Kelly. I'll look to my colleagues. Any questions on any of the policies? I was just thinking the 2.5% and 2% were a lot more manageable than what we've experienced in the past. So thank you for that. And the other numbers are on the smaller side, as just in terms of the aggregate. So I appreciate that.
The partnership with USI and our affiliation with the Steamship Mutual Protection Club has really protected us in this particular line of coverage. Everybody else, the numbers that they were sharing with me, we're seeing anything from 7 to 15% increases. But again, because of our affiliation with the Steamship Mutual Protection Club, we've really enjoyed minimal increases. They also indicated that the group from Steamship from London will be out in July, I believe. They want to meet with Ferry, obviously, but they also wanted to make sure that I extended it to Dennis or anybody on the committee that when they're out, if anybody would like to know about their membership or have any questions, I'll make sure that the group knows when they're here.
I think we're all waiting for that invitation to the Steamship Club.
I asked about that, but they didn't respond.
No, we'll keep trying. Director Grosbeck.
I'll move the matter.
Is So we have a motion in a second. Before we take a vote, is there anyone from the public who'd like to speak on this particular item?
We have no speakers in the room or on the phone for this item.
Okay. So once again, this is there's five policies in front of us on the on page 33, and we have a motion and a second. All those in favor, please say aye.
Aye.
Anyone opposed? Hearing no opposition, that does pass unanimously with all present. So thank you very much. Thank you, Kelly. Thanks for all the work. Moving on then to item number 7, the status report on the fiscal year 23-24 budget. Jennifer?
Happy to answer any questions. As you can see, we're up in all modes, so we are looking good for this last month.
Any questions on the status of the budget? Not seeing any. I do think that we have one public member who'd like to speak on this particular item.
We do. We have a member of the public who would like to speak on the public line on the phone. So Justine, would you like to invite our speaker?
Certainly. Our speaker is David Pilpel. David, go ahead.
Great, David Pilpel again. So I'm only confused about line 1 and the asterisk note on my favorite chart. Does about 12.2 million, which is about 30.2 million minus the 18 million of the ARP third tranche funds carry over to fiscal 24-25. I think the asterisk indicated that all of the funds were expected to be drawn down by the end of this fiscal year. Maybe I'm confused about the term drawdown versus use to address the budget deficit for the current fiscal year. So I would believe that there's about 12.2 that carries over to the next fiscal year, which I think puts the new fiscal cliff date after September 16th of this year, unless tolls are raised in July. So that was my quick analysis of the chart. Perhaps if you could put a question to staff to address my comment, I'd appreciate it. Thanks very much for listening.
Thank you, David.
Happy to clarify now if you
Please.
like. I think, as we always say with drawdown, so there's the cash flow part of it. So we will be drawing all the ARP funds down. And then, of course, as we go through the fiscal year and see what our spending rate is, then, we can tell you what the actual usage, but we will be using all the ARP tranche funds. So
we'll use less tolls than contemplated. And so we'll have additional toll carryover funds, but we will draw down all the ARP money so that Congress can't take it back. So draw it down as quickly as possible is what Joe, Jennifer, Cody, the team has been doing. And when we draw it down, if we draw it down and we don't spend quite as much as we thought, we can still draw it down and we can bank a little bit of toll money to push out the fiscal cliff.
Great. Thank you very much. Appreciate that explanation. This is a status report, so no action needed. We'll move on then to the monthly review of Golden Gate Bridge traffic tolls, bus and ferry transit patronage fares for the 7 months ending in January. Jennifer?
again, happy to answer any questions. You can see compared to budget that we are exceeding expectations. So that's good news for us.
And I am going to turn it over to the general manager to talk about seasonality.
Yeah, just I think because of the SMART meeting yesterday, there was a question about why is SMART ridership down compared to like the prior months. And we experienced seasonal travel in the Golden Gate corridor. So what they see is not dissimilar to us. We see it in all of our modes. So the bridge in January carried about 200,000 fewer vehicles southbound than it did in July. So we have an impact there. The bus impact is a little bigger than the bridge impact. So we carried about 7,000 fewer bus customers. Then the ferry impact is actually quite huge because there's two components of seasonality. One is when it's inclement weather, people are less likely to want to get on a boat. They're more likely to tell their boss they're working from home. Also, we don't have as much recreational travel, which is a big part of our ferry travel when weather is inclement. So we very much experience seasonality. I would like to mention that overall travel in the quarters continue to trend upward, which is positive, which is reflected on the numbers on the first page of the report. On page 49, you'll see that January bridge traffic was 7% higher than January a year ago. Because of seasonality, it's best to look at a month compared to the same month a year earlier to see what the trend is, as opposed to the prior month, which may have weather impacts. Bus ridership in January was 16% higher than January of 2022, and ferry ridership was 48% above January of 2022. Percentages, though, can be misleading. While it's 48% higher than the prior January, it's half of what we carried in July. And so that gets into the recreational seasonal component. But the good news is when you look at a month and compare it to the prior month a year earlier, we are trending upward in all three modes, and that really helps us financially. So I just wanted to draw your attention to that and highlight that we too have a very strong seasonal component to our travel, and it's primarily the recreational component, but even commuters seem to find a way to drive, take the bus, or take the boat a few fewer trips each month when the weather's less nice.
Just to add to that, you'll see that when we do the budgeting on by the month, you'll see that we actually look for that seasonality. So that's why you'll see, even if we don't match the budget, you'll see the numbers trend to the seasonality, since we kind of have history for that.
I appreciate that very much. And I would imagine there's a little bit of an uptick in that variability just based upon the flexible work environment that we seem to be in now as opposed to pre-COVID.
Also weather. If we have a really bad storm week, weekend or a week, we'll have fewer people driving on the bridge as well as taking our buses and boats. Then if we get a week of 70-degree weather, we'll have a lot more people out and about. Not going to work, but also doing other things. And it's very noticeable. And that's why reporting travel monthly is better than weekly, because you could have a bad weather week. The other day we had like 30-something thousand cars southbound. If you didn't know how bad the weather was, you would have cried. But then, yesterday we had 42,000 cars southbound. So it's actually by day that people make decisions about what they're going to do. That's reflected in the numbers that we see. But the good news is, month compared to the same month a year ago, everything's up.
We actually got a call from our toll system operator to want to make sure that all the lanes were working, because the weather was so, they weren't local, so they were not realizing the weather was so bad that the toll traffic had been so low. They were making sure everything was working okay.
31,000 cars. I think I was one of those cars, and I didn't want to be on the bridge. I was on my way to the airport, and the weather was just miserable. But yeah, I appreciate the fact that the bridge has a longer history and can look at those numbers. I think for us on SMART, the problem is, 7 years old, and there's been some pretty, it's been 3 wildfires and floods and different events that make the months go all over the place. And then trying to find those trends and to understand better the impacts just makes it more data, more better. So I do appreciate very much the bridges having that history. How about the monthly review of, is there any questions on that? We'll take public comment at the end of perhaps item number 9, which is the monthly review of financial statements for the 7 months ending in January as well. Jennifer?
I don't have any comments. I'm happy to answer any questions if you have them.
I'll look to my colleagues. Any questions? And again, this is not an action item. Is there any public comment on either this item, item 8, or in public comment in general?
We have no speakers in the room, and we have no further public comments, but I'm looking at the line and I see no one else new has joined us. So I'm going to confirm that we have no new speakers.
Okay. With that, we can move on to item 11, which is to adjourn. Could I get a motion to adjourn? I have a motion in a second. All those in favor, please shout aye.
Aye.
Hearing no opposition, we are adjourned. Thank you.